we can start with looking at some of the more important economic variables. So if we look at the GDP growth for the first quarter of the current year, that is for the period ending June, is reported at 20.1% on a year-on-year basis. Now that is sounding like a very good number, but that comes on the back of a very disastrous previous year, and then the low base effect. Within the GDP growth, the main component was the industrial sector, which led the growth with almost a 46.1% growth year on year, and the services sector grew by only 11.4%. That is understood because, as you all know, that the economy is still coming out of the uh, lockdowns, and therefore the industrial sector has continued to operate. Most of the factories and the plants were operational, but the service sector was still under the lockdown, like the cinema halls, traveling, vacation, malls, etc. They have now begun to open up in the months of September, October. This is for the month of June. Uh, Within the industrial sector, the construction was the star performer with 68.3% growth, followed by manufacturing at 50%. So what does it tell us about the GDP growth? That during the period April to June, when we had the second COVID wave and the whole momentum was disturbed, even during that time, the industrial segment continued to do well. The construction was the single largest contributor to the growth. That's why we keep hearing about the revival in the real estate sector, etc. And the manufacturing plants continued to operate, whereas the service sector did not do very well because the economy was still under the lockdown. On the demand side, the private consumption growth was at 19.3%. The government consumption declined by 4.8%. So again, you go back to the last year when the COVID started, government was the single largest contributor to the GDP because the government was giving huge fiscal support by way of financial assistance to people who were affected because of the lockdown, or by way of the support to the industrial segment. And this year, the consumption from the government declined by 4.8%, but the gross fixed capital formation, or the fixed asset investment growth, was at 55.3%. So even after the 20% growth in the first quarter of the current year, compared to FY20, that is from before COVID, the GDP growth was down by about 9%. However, we have the RBI projecting growth at 9.5% in October policy, and the risk to the GDP growth comes from a possibility of a third wave. So right now things look very good for India. The number of daily cases are just about 10 to 12,000. However, if you look at countries like Germany, they are giving new cases of almost 50,000 plus on certain days. So the risk of a third wave still is there. If we look at the inflation scenario, there is a mixed kind of news here. Yesterday or Friday, we got the October CPI number. The October CPI number was at 4.48%. This is compared to 4.35% in September. So there is a slight increase, and that is led by the food and beverage inflation. The food and beverage inflation is up 1.8%. The fuel component continues to be a very significant contributor to the inflation. The fuel and light inflation was at 14.3%. The core inflation, which is the inflation other than the food and the fuel, etc., rose to 6.17% versus 5.86% in September. So the core inflation will include items like housing, healthcare, entertainment, etc. The WPI inflation, which largely denotes the impact of the higher commodity prices, continues to be on the higher side at around 11.5%. The RBI projection for the inflation is at 5.3% for the full year FY22. That was revised down from 5.7% in the August policy. So from RBI's perspective, from the market's perspective, overall the inflation continues to behave well. The headline inflation number is around 4.5%, which is in the lower quadrant of the RBI range of between 4 to 6%. So inflation is closer to 4% than it is to 6%. That gives the Reserve Bank a little bit of an elbow room. However, the core inflation is still very high, above 6%. So that does not give a very comfortable expectation. We have the upside risk to inflation because of the higher oil prices. As you all know, that oil prices are $80 plus, which is like last 5 years high price, and the supply side disruptions are still continuing. There is some improvement in the situation as the economy opens up, but there are still significant supply side disruptions. So the upside risk to the inflation remains. The base effect that we saw last year also is evaporating, so that could also lead to higher CPI number. But at this point, when the Reserve Bank wants the economy to continue to grow and wants to continue to support the economy, a low headline inflation number of 4.48 is a little bit of a breathing space for the Reserve Bank. If we look at the IIP growth, the IIP for September, again, that was released in on Friday, is at 3.1% higher compared to the September of 2020 and 11.9% in August. It declined by 2.6% sequentially, but the important thing is compared to September 2019, now the IIP is higher by 4%. That means now we are seeing the first signs of the economy coming back above the pre-COVID level. So that is a good news that we have. The sectoral basis growth, the IIP mining sector was up 8.6%, manufacturing 2.7%, and the electricity sector grew only by 0.9%. So that shows the impact of the coal shortage that we were talking about 15 days back. In terms of the user-based classification, primary goods were up 4.6%, intermediate goods 4.9%, and capital goods 1.3%. There is a significant pickup during the festive season. This number is for September, but we have seen that in October and November, there is a significant pickup in the industrial activity, and therefore I believe that in the coming months, you will see even stronger data on the growth. Insofar as the fiscal deficit is concerned, the Reserve Bank has taken the projection of 6.8% from the budget document for the current year in order to manage the borrowing program of the government. Last year, the fiscal deficit was 9.2%. This year, it is projected at 6.8%. We have some very good development on the fiscal deficit side. First, there is increased transparency. If you recall, last year, there were items like the food subsidy and all, which were not reflected in the budget very clearly. But this time, the government has taken the entire food subsidy in the main budget document. Their higher expenditure on the capital side. But more important is that for the first half, which is for the period April to September, the government fiscal deficit is only 35% of the budget estimate. So if, for example, the budget projection was at 6.8%, the actual deficit is only 35% of the budget estimate. Typically, last year, for example, the first half fiscal deficit was almost more than the target, 114.7%. The current 6-month income is at 11 lakh crore or 11 trillion, which is again 55.6% of the budget estimate. That means it is more than 50%, because at half year, it should be ideally 50%, and the expenditure is at 16.3 trillion or 16 lakh 30,000 crore. Again, the expenditure is only 46.7% of the budget. So you can see that the income or the receipts are 55% of the budget. The expenditure is only 46% of the budget. Therefore, obviously, the fiscal deficit is significantly better than target for the first half of the year. The net tax revenue has been a significant factor. the GST collections you must be reading in the papers are far better than the projections. So around 60% of the budget for FY22 has already been collected in the first half of the year. Normally that range is between 35 to 40%. So there is a huge improvement in the tax collections by the government. And so far as the current account deficit is concerned, the current account surplus for the first quarter, which is again April to June 2021, was at $6.5 billion or about 0.9% of the GDP. The current account deficit was 1% of the GDP in the previous quarter, which is January to March 21, and in the year before that, in the first quarter of 2021 fiscal year, there was a surplus of $19 billion. So why the last year's surplus has suddenly become a deficit is that you will recall that last year in the period of April to June, there were significant flows because of the Geo getting participation from Facebook, from a lot of the foreign investors, Deep Silk Route, etc. So Geo itself got about $20 billion plus of the forex flow at that time. So last year in the first quarter, that is April to June 2020, we had a surplus of $19.1 billion, which this year is just about $6.5 billion. This improvement in the fiscal deficit has happened because of the reduction in the trade deficit and improvement in the capital account flow. And the current account surplus for the full year FY21 was at $23.9 billion, again largely led by the huge investments that came into the Geo and other fintech sector and the startup sector. The overall external sector, we believe, will remain comfortable. However, in the recent months, we have seen a trend of widening trade deficit. The commodity prices are still high. India is one of the largest importer of commodities. So the steel, copper, aluminum, all prices have gone up. That might impact our current account deficit. And now the gold prices have also turned positive on a yearly return basis, around $1,825 per ounce. So the gold demand and the gold import price may also get impacted. The policy normalization that is happening in the United States and across the globe can also affect the current account deficit. In terms of liquidity, we have remained hugely surplus. As you can see in the right hand side chart, the gray line is the amount of excess liquidity in the system. Now last 1 year we have got 100 billion plus dollars of increase in the forex reserve. From about 525-30 billion dollars, we have come to 640 billion dollars. So that 100 billion dollars are about 7 lakh crores of additional liquidity that has come into the system. That is over and above what the Reserve Bank has been adding through the LTRO, TLTRO, etc. during COVID time. However, now the Reserve Bank is moving towards normalizing the liquidity, and they have been taking different measures, like they conduct the variable rate reverse repo, which sucks out liquidity, excess liquidity from the system. They will increase that amount of the VRR from 4 lakh crores to 6 lakh crores in the last policy. And then they have also increased the tenor or the maturity period of the auction from 7 days to 28 days. And therefore, as a trend, we are seeing that the cutoff with the variable rate reverse repo auctions has been moving closer to 4% in the 399% band versus 3.25, 3.35 rate, which we saw in the before the RBI introduced these measures. RBI continues to maintain that it will maintain adequate liquidity in the system, and we know that the Federal Reserve is going to start reducing its bond buying starting from the current month. So right now the Federal Reserve of US is buying around $120 billion of bonds every month. They are going to reduce that by $15 billion every month. So over the next 8 months, starting from November of 21, going up to June 22, they will stop buying bonds from the market. That is what the tapering that everyone keeps talking about. In terms of the credit growth, you can see that after 2018 October, the credit growth has been coming down and down. However, you can see in the recent months, the credit growth is beginning to pick up. So last quarter, we had a credit growth of 6.84%, which is the highest since April 20. So in the last 6 months, this is the best growth that we can see. And this is a very new situation for our country. For the first time, the retail credit now is more than the industrial credit. What we have seen this last 6 months is that most of the large corporates are deleveraging. So you look at Tata Steel, uh, Steel Authority of India, even the strong companies like Ultratech, they're all on a mission to reduce debt. Tata Motors, Vedanta, everyone is reducing debt. So people are benefiting from the super commodity cycle that we are seeing now. The commodity prices have shot through the roof. They are all trading near their all-time high. So all these commodities companies are getting a lot of money. They are repaying. And then the growth has suffered because of the COVID. Even before the COVID happened, the growth was slowing down. So there is no demand for new capacity, and therefore there is not much of credit that pickup that is happening. Banks are only lending to the retail customers for the housing, for the vehicle loan, and for education loan, and so on. So the retail is becoming a very important part of the credit business of the banks, and that is the segment which is growing in double digits. Uh, there is some hope that the capex will pick up in the coming months, but then let us see how it goes. Because the government has now introduced the profit linked, incentive scheme, and there is an expectation that a lot of new money, new investments will come into India because of that. That might lead to higher credit requirement, but at this point, the credit pickup is very slow because there isn't much new capex that is happening in the industry. So that was the summary of some of the domestic factors. So we looked at key important variables like the growth, the fiscal deficit, the liquidity, etc. Now let us look at the global environment. What is happening in the global environment? Insofar as the central banks are concerned, the global central banks are gradually moving towards tapering. As we discussed, the Federal Reserve has already announced its calendar for reducing the debt buying program to zero by June of 2022. The inflationary pressure is very strong in the global markets. For the month of October, US posted an inflation number of 6.4%, which is the highest inflation in more than 30 years in US. So that is a challenge that is coming there. The Fed will begin, as I mentioned, by $15 billion per month. The ECB and the Bank of Canada and the Australian Central Bank will follow. Australian Central Bank was trying to control the market yields. They have given that up. So the yields have gone up in Australia. New Zealand Central Bank, the South Korean Central Bank, the Norway Central Bank, they have already increased rates already. So have the Brazilian Central Bank, Turkish Central Bank, and the Russian Central Bank. So globally, the environment is turning slightly unfavorable for the fixed income. Then we have the COVID situation, which is having a huge impact on the fixed income market. So because of the COVID, the central banks took such a easy monetary policy and they all reduced interest rates. Now that COVID situation is beginning to stabilize, some of that extra liquidity and the lower rates will be unwound. Now, what is the situation for the COVID? We are seeing a huge number of cases of COVID globally. I mean, if you look at a small country like Germany in terms of population, they are giving new cases in the range of 40 to 50,000 per day. In the US, the new cases had gone up to 2 lakh per day. Then they increased to something like 50,000 per day. But now again US is looking at somewhere between 75,000 to 1 lakh new cases per day. Singapore is a very small country with a total population of just about 60 lakhs. They are seeing 5,000 cases per day. So globally, there is a huge concern about the high number of cases. However, the good news is that with the vaccination having been done, the fatality rate and the hospitalization rate has been very, very low. And that's why, in spite of such a huge surge in the new cases, there is no talk of any fresh lockdown in any of the countries in the Europe or US. And that is some hope that uh, the economic growth can continue. However, after the bump up that the growth got after the economy opened up in US and Europe, skepticism is now building up as to whether that growth rate can be sustained. And the incoming data is mixed. Sometimes you get a good data, sometimes you get an average data, sometimes it's a poor data for growth. So let me just give an example. The PMI, which gives the momentum of growth or how market participants are thinking about the growth, has been coming down in Europe, Japan, and in US. However, the actual data that come of the inventory or the sales, that is good. For example, the US retail sales data last month was up 10%. Housing data is good. Employment data is good. Last Friday we got the new employment claims in US were the lowest in more than 6 months. So that way the data is mixed, but it is expected that the economies may not be able to repeat the growth of 2021. In US, in the current year, the GDP is expected to grow at 6% plus. It is unlikely that US can repeat that performance. Then, if you look at the geopolitical scenario, the new domestic Democratic president in US, Mr. Joe Biden, is expected to reduce the friction and the uncertainty and volatility in the global environment. The issues are still the same. They have a problem with China, they have a problem with Afghanistan, they have a problem with Iran, but the way new president is handling those same situations in a more politically suave and nuanced way. We are not getting the daily nasty headlines that we used to get when Mr. Trump was president. And in terms of the disruptions possible, China, Iran, Israel remain potential disruption points. I think there is a lot more probability now of a Taiwan-China clash than an India-China clash. The China attention has also got somewhat diverted to Taiwan. Therefore, we are seeing relative peace on the Ladakh border, and that is a good news for India. So geopolitically, the things are stable. In terms of the COVID, the number of cases are going up, but the central banks or the governments are not in any mood to impose fresh lockdowns. There is skepticism about the growth, and the momentum is moving towards the normalization of the market policy. So how do we look at all these things? I spent the last 20 minutes discussing individual elements of the fixed income thing as to how we started with looking at the GDP growth in India, fiscal deficit situation in India, current account deficit in India, the status of the IIP in India, inflation trajectory. So you look at each of these items individually, and then you look at the global environment, what's happening on COVID, what's happening on the US Fed policy, etc. Then how do we combine all these things and make it into a interesting view? How we can use this information to form an interested view, and also how to use that view for the construction of the fund strategy. So first of all, let us look at this way. The Reserve Bank's current ultra-loose monetary policy was largely an response to the COVID emergency. Because of the COVID, the markets broke down, the economies broke down, and Reserve Bank needed to step in to stabilize the financial markets, to allow the economy to grow back. That's what every central bank did. Now, what we look at the markets, our equity markets are at all-time high. Our currency is very stable. the interest rates are very low. So we have financial markets which are stabilizing. Therefore, one reason for which RBI took this ultra loose monetary policy, that is to stabilize financial market, that objective has been achieved. The second was the economic recovery. Now our GDP growth, as we already discussed from IIP perspective, is already trending or beginning to inch above the pre-COVID level. The current year's GDP growth is expected at 9.5% by Reserve Bank and by the World Bank, and possibly by the next quarter we can come above the pre-COVID level. So that will be one good big benchmark achieved. And then the global policy environment is reversing. So ours is a country which is a country with a large current account deficit. So we need to be very sensitive to what the other central banks are doing, especially the Federal Reserve of US, because that is the mother market for everyone. So globally, as we discussed, the monetary policy reversal is happening, and therefore the Reserve Bank has to also follow that trend. Now, what the Reserve Bank is doing right now to indicate to us that they're trying to normalize the monetary policy. First, they're doing larger and longer VRR, variable rate reverse repo at auction. So what I already mentioned, that now the Reserve Bank is going to conduct variable rate reverse repo auctions of almost 6 lakh crore. So total liquidity in the system is in excess of about 10 lakh crore, out of which this RBI is going to absorb 6 lakh crores. My guess is that they will increase that amount further. So suppose if that goes to 8 lakh crore, then gradually the liquidity will tighten. There is no extension of the GSAP, Government Securities Acquisition Program. In the first 6 months of the year, from April to September, RBI bought about 2,20,000 crores of bonds to support the market. Now RBI has stopped buying the government bonds under the Government Securities Acquisition Program. And then we have the mixed MPC minutes, where you have the governor and couple of other Reserve Bank staff, supporting continuing of the softer monetary policy. However, the external members are beginning to pressure the MPC to tighten the monetary policy. One member wants the rates to be hiked, other person wants the liquidity normalization to happen, another person says that look, we have to be watchful of the inflation. So gradually I think the Reserve Bank is giving us signals that they need to normalize the monetary policy. Now normalizing monetary policy doesn't mean that they have to hike rates or they have to take any drastic action, but I think the intensity of support that the Reserve Bank has shown in the last 1.5 years, that will ease out, and we are already seeing the money market rates going closer to 4% from 3.35%. Then what happens post wave 2? The growth momentum remains strong. So localized lockdowns had limited impact on the GDP growth. As we just saw, that IIP is back to above pre-COVID level. Exports are holding strong. We are fortunately in a situation where the US and Europe is opening up, whereas the countries in Southeast Asia like Philippines, Taiwan, Thailand, Vietnam, they are suffering from their worst situation of COVID in the last 1.5 years. The Southeast Asian countries are our primary competitors for exports, and the US and Germany are our primary target, investors or the markets in the export segment. So therefore, India's exports have grown very well, and then the COVID cases have been coming down. On top of this, in the current year, the government did not need to give any major financial relief package, unlike in 2020. So the fiscal deficit condition has also been very, very good. And then you have the stabilizing global yields. In US, as I mentioned, the inflation is at 6.2%. Global central banks are indicating that they will stop quantitative easing, and they will gradually remove the accommodative situation, although the overall stance will remain accommodative, and the bond buying will start slowing down from the current month. So US benchmark rates are at around 1.6% level. They are already pricing in a rate hike by the Fed. So what is the conclusion? That we think that the interest rates will remain range bound. There is no scope for the rates to come down by any meaningful level, but a Reserve Bank is still in an accommodative mode. They want the long-term rates to not go up. Therefore, if there is any undue volatility or a sharp spike in the longer-term rates, the Reserve Bank will intervene through open market operations, etc., and arrest that. And at the same time, we might see the short-term rates go up because the RBI wants to remove the excess liquidity. So all in all, we may see a bit of flattening of the yield curve. The short-term rates may go up more than the long-term rates. Right now, we have the inflation at a reasonable level for India. The fiscal deficit situation is looking good, which is the fiscal prudence, and the supply concerns in the second half for the high supply of the government bonds. uh, in the first half, the RBI was doing GSEP. In the second half, we are seeing that the borrowing amount is, smaller than the previous year, and therefore that is some comfort for the market. And the Reserve Bank has also switched its language from not allowing the market yields to go up to an orderly evolution of the yield curve, which means the market yields are now at a reasonable level where the market is happy to take that comfort of the valuation. So our belief is that right now for India, the situation is stable. Indian rates can remain range bound, but the global environment, we have to be very watchful because we are seeing that the global central banks are beginning to tighten. And if there is any volatility, then it may affect us. So that was the broad market outlook. So just to summarize what we think of the interest rates, globally, central banks are beginning to tighten the liquidity. That for now is affecting the short-term rates more than the long-term rates. Over the longer period, the expectation is that the central banks will hike rate, but they will do it in such a smooth way that the market impact will be minimal. And therefore, at this point, we should expect a range-bound interest rate environment where the short-term rates will move up more than the long-term rates. In terms of how we manage our funds, our overall approach is rather straightforward, simple, and intuitive. When the interest rates are going up, we reduce the duration in our funds, and when the interest rates are going down, we try to increase the duration in our fund. How do we know that interest rates are going up or down, and how much we increase the duration by? Let's look at this slide first. So what we do is we first look at all the different factors which affect the interest rate. So like we look at the inflation, liquidity, GDP growth, fiscal deficit, so on, and then we look at the global factors which affect our domestic interest rates like the global central bank policy, growth outlook, and so on. And then we take a conclusion based on this, and which is why if you now go back how I started my presentation, I started by looking at the GDP growth, fiscal deficit, credit growth, etc. Then we looked at the global environment, and now we are in a position to decide what we think of interest rates, whether they are going up or down. So we normally classify all our assessment into one of the three categories: positive, neutral, or negative. So if we are positive on the global environment and if we are positive on the domestic environment, then we are aggressive, which means we try to maximize the duration that we can take, and vice versa. When we are negative, then we are protective. At this point, we are slightly neutral to slightly negative on domestic, and therefore we are cautious. We are neither too aggressive nor too defensive. We are trying to have a balance between the YTM requirement of the fund, the capital requirement of the firm, and the possible risk if the interest rates go up by a huge margin or at a significantly faster pace in future. So once you look at this slide, you know exactly how we are thinking and what is our fund positioning, and that should help you take the investor easy, uh, view on our funds. In terms of how our different funds are positioned, this is how we like to present our funds. We have the overnight and liquid fund, which obviously cater to the shorter term requirements of people. Then we have the ultra short term fund, money market fund, and the low duration fund, which are somewhere in the 6 months to 1 year category, where the duration risk is less, the credit risk is less. Right now we have a very steep yield curve. So let's say the overnight rate is 3.25 and the 1 year CPCD rate is somewhere around 4.5. Even the 1 year T-bill is at around 4.1. So that gives the market some yield creating opportunity. And then we have the short duration fund, the corporate bond fund, the banking and PSU debt fund. So these are the funds which are the medium to slightly longer term horizon investors choice. In case of short duration fund, people with investment horizon of let's say between 18 months to 30 months can come. And in the corporate bond fund and banking PSU debt fund, again, people with investment horizon of 2 years plus. In terms of how we manage is that we try to keep the duration low when the interest rates are going up and vice versa. In banking PSU debt and corporate debt fund, for example, we try to maintain a duration range of between 2 to 5 years and short duration fund of between 1 to 3 years. Then we have a very niche, beautiful product, which is the dynamic bond fund. In this fund, we are carrying or focusing rather on 5-year kind of a corporate bond, AAA PSU and the SDL. So this fund will typically have 50% in SDLs or state development loan and 50% in AAA PSU. And we will rather keep that portfolio stable so that the investors can look at a return of YTM minus expense for over a 5-year period. So this is a category which has found a huge favor recently, and therefore I think this will work very well with the investor. With that, I will take a pause and I will be happy to take your feedback. I will be happy to take your questions now. Thank you so much for your patience. Thank you. Moderator, back to you. So we have a few questions. I will take the first question. Are there any avenues for the charitable trusts to invest in debt market? So trust can invest in the mutual funds. Obviously, the trusts have to invest in the debt funds which have the approval from the charity commissioner. Uh, so there are different funds. Some of them may have approval, but by and large, the trusts do not have the approval. So there is very limited exposure in this category. Do we have any other question? So there is a lot of concern about the interest rates going up. The next question is that based on core inflation, isn't RBI more inclined to raise interest rates? Now that is a very interesting question. As we understand that the Reserve Bank is right now caught between the objective of supporting growth versus, taking care of the inflation. At this point, as we looked at the different numbers, as far as India is concerned, the macro fundamentals are very strong. So having we have a situation where the growth is beginning to rebound. The economy is opening up. The number of COVID cases have come down. The vaccination levels in India are also now very, very high. So the risk of an uncontrollable spread of the virus is reducing, and therefore it is expected that the GDP will grow very, very strongly. RBI doesn't want any roadblock or any factor that can put a bump or a constraining factor to that growth, and therefore they would want to continue to support the growth by keeping the interest rates low. The inflation is reasonably stable at around 4.5%. It is possible that interest rates go up from the inflation go up from here in the next 6 months. But inflation is not like in US. You see, inflation is at 6.2%. Fed's mandate is 2%. So in US, the inflation is more than 3 times the inflation target of the Fed. In India, the RBI's inflation target is in the range of 4 to 6%, and inflation is largely there. The fiscal deficit situation has improved. As I mentioned, the current year's revenue collections are extremely encouraging. Therefore, it is most likely that the government will be able to manage within the projected fiscal deficit target. And given that what Reserve Bank would want is to keep interest rates low rather than go up. However, the Reserve Bank also has to keep in mind that the Federal Reserve of US is a major influencer. So therefore, if the Federal Reserve of the US, Fed, is going to hike rates or tighten liquidity, RBI cannot be seen to be left behind the curve. So if that happens, and if a negative perception about India develops, then FPIs can take the money back. So Reserve Bank cannot be seen to be behind the curve, and therefore they are taking action. So when we look at the Reserve Bank action, we need to look at in two parts. One is that the extraordinarily loose monetary policy that the Reserve Bank implemented because of the COVID situation. And then the second part is the hike in the rates from the neutral level. So what Reserve Bank is right now doing is switching from extraordinarily helpful situation to normal situation, which is why we keep using the term normalization of the monetary policy. And that is where the short-term rates will go up. The reverse repo rate may have to go up without affecting the long-term rates too much. Then if the global situation becomes bad, or if the inflation goes higher, then the Reserve Bank may think of hiking the rates. So in my view, the hike in rates is a little bit away, maybe at least 6 months away. Then there are so many more questions. So let me just take one question which summarizes the overall situation. The question is that everyone feels that the interest rates are going up. In that situation, where should people invest money if they have a 1 year investment horizon, right? And then there are questions that which is an ideal debt fund for 3 years, right? What is the option if somebody has 3 to 6 months to park their money? So let me just put it this way. We have seen our chart on the positioning of the different funds. So let me just first deal with this situation that somebody has money to invest for 1 year, and he's expecting the RBI to hike the interest rates sometimes later in the year. What should he do? In my view, there are two categories of funds which address this situation. One is the money market funds, the other is the low duration category, because in these funds, typically the investments are in the maturity range of between 6 months to 1 year. In case of money market fund, the no security can have a maturity of more than 1 year. In low duration category, people can have longer maturity securities, but the average duration of the fund should be between 6 months to 1 year. So technically, it is not possible to go very long in different categories. So if the interest rates go up, these funds will have shorter maturity securities, and they will see quick maturities of the investment. So the fund manager can invest the new money and the maturities at the higher yields. Even if there is a yield loss or the NAV loss because of these rates going up in the first, say, 2, 3, 6 months, by the time you complete 1 year, most of these papers will mature, and therefore your NAV will bounce back. So in my view, with a steep yield curve, these two are the categories which suits the people who have, let's say, 1 year investment horizon. So low duration and the money market category. For people who have 3 year plus investment horizon, I think they should just stick to their asset allocation. They should look at funds like banking and PSU debt fund or the corporate bond fund. We have seen that till 6 months back, these funds were giving 10% plus return. So whenever the market conditions improve again, those funds will give good performance. So what is the call that you have to take, that in the next 3 years, whether interest rates will go up and then again come down, or they will go up and continue to go up, etc. We have seen that interest rates are cyclical in nature. They go up and then they come down. When interest rates go up, the inflation comes down, the liquidity tightens, so the inflation starts easing down, then the central banks reduce rate. When interest rates are low, inflation goes up, the liquidity goes up, and therefore central banks start tightening. So this is a cycle which will continue forever. What we have seen is that typically that interest rate cycle is completed in 3 years, and therefore if you remain invested for a period of 3 years, there is a chance that you will make close to double-digit returns. So people with a 3-year investment horizon, in my view, should not worry about what is going to happen to interest rates in the next 3 or 6 months. They should look at remaining invested for one full interest rate cycle to maximize their return. For people who have 3 to 6 month investment horizon, it's pretty straightforward that they will have to remain invested in the liquid funds or the ultra short term funds. There is a question as to what is my opinion on equity markets correction with Fed increasing rates and FPI selling out. I'm sorry, I don't cover equities, and therefore I would not like to talk about equities, even though I may have my view. But I think if you want our equities view, maybe we can connect you with our equity team. Now, what would be the average debt fund return over the next 5 years? In my view, if somebody is going to remain invested for 5 years from here, uh, maybe he will get 10% plus return, which he has been getting if he has remained invested for 25 years. Because why do we think so? What is the rationale for saying that debt funds will be closer to double digit? Because simple, India's fundamentals are very, very strong. So 15 years back, we had interest rates of 15%, 16%, which has now come down to 5%, 6%. The global environment is where a lot of countries have negative real rates. So you look at Germany, you look at US, they have negative real rates. You know, even though in US the 10-year yield is 1.6, but the inflation is 6%. So globally the rates are all coming down. You look at Thailand, Malaysia, Vietnam, those small countries, their 10-year yield is 2%, 2.5%, 3%, right? India's 10-year yield is still 6%. So if you look at 5-year, what is the chance that the 10-year yield comes to 2.5% like Thailand or Malaysia, or it goes to 13, 14% like Brazil? I would say that with improving fundamentals, improving macro environment, and now especially with the Indian bonds possibly getting included in the global bond index, I would say that 5 years down the line, I will expect the debt funds to give more than double-digit returns, then much higher probability of that than the debt funds giving low single-digit return. So that is one. And right now, the 5-year part of the yield curve is the most attractive. If anyone has that question, that which is the most attractive segment of the yield curve for the FPIs right now, for anyone, why only FPIs? The 5-year curve of this 5-year part of the curve looks very good, with a yield of between, say, around 570, 75. The yield curve is very steep. Even if the Reserve Bank were to normalize liquidity, short-term rates will move up more. So we believe 5-year is the most attractive category at this point of the on the yield curve, or maybe between 3 to 5 years. So that's all. If there is any other question, I'm very happy to take it now. Okay, then thank you so much everyone for your time and patience. If you have any further questions, you can connect with me later. Back to you, moderator.